The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome to the Fed15 podcast, presented by Serving Those Who Serve. Each week, we discuss the latest news and info the Feds need to know in 15 minutes-ish or less. So whether you are a seasoned federal employee or just starting out in your career, Fed15, we've got you covered. So grab your coffee, your green juice, your energy drink, whatever gets you started, kick back, and we'll tell you what you need to know but might have missed. We're your host. I'm Dan Sipe, and I'm joined once again by the incomparable Jennifer Meyer. Welcome back, Jen, again.
Thanks. 2 weeks in a row. Super
Indeed.
exciting. Happy to be here.
Indeed. Makes for a very fun spring having you with us. And you're all ready for spring, right? We were talking earlier today, Jen, and you weren't too happy with the recent weather snap here in the DMV.
Yeah. I'll tell you. I mean, it's almost May, right? It's time that we don't have 40 degrees anymore. So I'm trying to will it with my outfit today, my nice spring summer look. So
you're looking very springy. Very, very smart. So, okay, folks, well, we could talk about the weather all day long, but we're not going to do that. We have some very interesting topics today that we're going to be covering. Jen's going to be telling us about some tax breaks the feds often miss. And that is always a great thing to hear after we've just come out of tax season, because as soon as you finish one, you're starting the other. And then I'll be talking about something that's super near and dear to our heart here at Serving Those Who Serve, and that is milestones. So Jen, why don't you kick us off with some of the tax things that the feds might miss?
Yeah, absolutely. And I love talking about this, by the way, because it's so important. And I feel like it's something that so many people miss, right? Especially as they're sort of transitioning into retirement. So many things to think about. And oftentimes people are surprised in those first couple years with taxes that they weren't expecting. So I'll start by kind of just framing what I consider to be a very smart way to plan for taxes. And that's having what we would call tax buckets, right? So people sometimes say to me, oh, like the bucket strategy. Well, this is not an investment bucket strategy. This is a tax bucket strategy. So you really have three buckets in terms of your taxes, right? You have what's called the taxable bucket, which typically would be things like brokerage accounts, bank accounts, non-retirement accounts, right? And then you have your tax deferred bucket. Tax deferred buckets typically include your traditional TSP money, traditional IRA money, things like that. And then you have a tax-free bucket. The tax-free bucket is typically made up of Roth TSP or Roth IRA money. This gives you the ability to pick and choose from different types of tax implication accounts when you're drawing from your investments. So, like, for example, right, most federal retirees are going to have their either FERS or CSRS pension, and that is going to be taxable at the federal level. Maybe not 100% taxable, but for our conversation, it's mostly taxable. Depending on Social Security, if you're drawing your Social Security, that is also going to be taxable at the federal level. And then if you're drawing income, which many retirees are, that's what you've saved money for all these years to be able to draw on it in retirement, you're going to be paying taxes potentially on that money. And very often it's the traditional TSP or traditional IRA money that you have to be very conscious of, because that is the one bucket that's going to be treated as ordinary income. right? So typically your brokerage accounts, that's taxed in a different manner. Roth money is the tax-free money. Your traditional tax-deferred money, that's the one that for many, many people becomes, ooh, I didn't realize that conversation, and they get hit pretty hard with taxes. But the point is that by having these three different buckets, you can be strategic in how you set up your taxes, right? So with Roth conversions, which are a very hot topic this year in the world of TSP, because for the first time ever, you're able to do in-plan Roth conversions. And that is something that we're talking about all the time. And the benefit in some ways of doing this is that you are planning your future tax-free bucket, right? So
Sure.
you want to have money in all three buckets because it gives you flexibility in retirement. So having a good Roth conversion strategy really can help you reduce future taxes and maybe even IRMAA premiums too. And that's probably a little bit beyond what I want to get into today in terms of Medicare and IRMAA premiums, but that is something that a lot of our feds face when they are retired and potentially taking Medicare. And because they have good guaranteed income sources, sometimes they end up in higher IRMAA brackets, and Roth conversions are another way. So the point really, though, that I think is the takeaway for today is that timing can have a big impact on your taxes in retirement. And it is something that in many ways you do have control over. So for example, and this is another situation that happens all the time, where somebody says to me, hey, I'm retiring, I'm going to pay off my mortgage, or I'm going to go buy a vacation home, or maybe I just want to take the family on a really big trip, right? Take the whole family, the kids, the grandkids, the spouses. And that sometimes will mean a large TSP, traditional TSP withdrawal. That kind of a withdrawal can very easily throw people into higher tax brackets, and people have no idea, right? With planning and strategy, you can maybe plan that out in a more tax-friendly manner by taking those withdrawals not all at the same time, right? Maybe spreading it out over a couple tax years and things like that. The other things that sometimes come into play, again, Roth conversions. Everybody's excited about Roth conversions right now. If you do a big Roth conversion, you also potentially are throwing yourself into a higher tax bracket. And we want to avoid that, right? We want to avoid surprises on the tax front. So I kind of want to transition over to other ideas and other ways that people manage taxes in retirement that, a lot of people don't think about, right? So let's talk about healthcare and charitable strategies, right? So in the healthcare space, and this happens actually more often than you would think, one situation, and it doesn't apply to everybody, but it is possible if we have a couple that are both federal employees and one of those employees is going to continue working. Well, it makes sense that the employee that's going to continue working would pay the health insurance premiums because as an employee, those premiums are pre-tax. As a retiree, they are post-tax, right? Simple strategy, but a lot of times, people just don't think of that. The other thing is on the charitable strategy front, right? So there are ways to mitigate your taxes using charitable strategies. And there's things like donor advised funds that can be very effective in years where, you might be taking a large traditional TSP withdrawal, things like that. Qualified charitable distributions are another mechanism. There's something that you can take advantage of as early as age 70 and a half and can oftentimes be used to manage your taxes in retirement. So
Sure.
That's all, sort of the strategy around tax planning and retirement. The one last thing that I want to comment on, because I hear it all the time, is, I'm going to move to a more tax-friendly state in retirement, right? And, it's absolutely true that there are states that can be more tax-friendly in certain situations, right? If a state doesn't have a state income tax, then obviously you're not paying state income taxes on your pension, your TSP withdrawal, so on and so forth. But what I always caution people is the states have to make money somehow, right? They are
Sure.
all making money. And so if you're not paying an income tax, you might be paying higher property taxes. You might be paying higher sales taxes.
Sure.
Insurance costs oftentimes are higher in, different states that sometimes are more friendly in state income taxes, right? Like Florida, great example, right? Florida
Sure.
has no state income tax, but you're going to pay a lot for your homeowner's insurance in Florida. And finally, healthcare access, right? These are hidden costs that people think, well, I'll just go to a state that doesn't have a state income tax and I won't pay tax there. Well, there's going to be other costs that you're going to be paying. So you have to be careful and plan, right? And that's really the point here, that planning is what can make the difference. And the last thing I want to say is that, we have a great webinar that Ed Zerndorfer does on tax planning. It's one of my favorites, always has been. If you have additional questions on that front, take advantage of that webinar. I think the next one I saw was coming up on May 5th. So it's a good one.
Absolutely.
And Dan, I think that's all for me on taxes, and I'll let you talk about all our milestones because that's super important.
Yeah, that's something you're going to see more and more and more from us, folks, as we are always working on ways to reach, teach, and serve. And so one of the things, together with my partner Tom and the whole team here, that we are brainstorming around is that there are dates and ages that occur in federal service that, remember, this all goes back to me asking one question where my father-in-law was concerned, which is who was looking out for him. So as part of the who's looking out for you, and we take that very seriously, we want to identify the meaningful dates, meaningful ages. So I'm going to toss out a little teaser here. I'm not going to cover them all today, but we've got it up to 51 different dates or ages in a Fed's life cycle where a difference can be made. And I'm old enough to remember board games. And actually, one of my favorites was the game of life. Had the cool little spinner in the middle. And, it was kind of a 3D board and plastic. But there were places where if you landed wrong, you went backwards or you missed a turn. We don't ever want that to happen to our Feds. So I'm going to hit some of the milestones. Stay tuned, folks. We are going to have content that we'll be pushing in the second half of the year that's going to cover all 51, and it'll be 52 as soon as we find it, if it's out there. So while I'm on 50s, let's start with age 50. So a couple things happen here. Number one, you're able to start making catch-up contributions for TSP. Okay, this year that's $8,000 if you are age 50. Now, we'll learn a little bit later, there are some enhanced ones that certain people get. So it's a good opportunity to close a gap that may have occurred. Because I don't know about you, but I remember when my kids were little, not having as much extra money as I did later in life. So catch-up is a real thing. Another thing about age 50 for our beloved special provisions employees, you're eligible for retirement, okay, at age 50 with 20 years. You can actually go earlier if you have 25. So that's an important thing around age 50. Here's one that just slides by people. And Jen, I know you talked about it a lot in the last year. I talked about it a lot in the last year, where we had Feds that were essentially having to retire way before they wanted to. Okay. And they were going out on, for example, discontinued service retirement. So that they had the years to be able to do it, but they were well before minimum retirement age. Well, one of the things that we were able to help people understand is the rule of 55. Okay. So if somebody retires in the year that they turn 55, they are able to withdraw TSP monies without being hit with the 10% penalty. Nobody gets this. Okay. We just nerd out with it all the time, so we're paying attention to it. So that's at age 55. Age 57, all right, I'm going to say it. That's earliest retirement eligibility with 30 years of service. That's the earliest MRA. If you're going to go out at age 57 with MRA 57, you need massive retirement assets. Absolutely. So the biggest reason for that, and this is the one that never seems to make it into the brochure, is that you are going to go 5 years without a COLA. 5 years. Okay. So that could be a real problem for you. Next up, we've got 59 and a half, which is TSP Liberation Day. That means you have options. So I'm not saying, hey, run right out and move everything out of TSP. I'm also not saying keep everything in TSP for the rest of your life. Make a deliberate and considered decision. This is where you have the ability, if you're working, to move a portion or all of your TSP into an outside account, not making that as a recommendation. I want to be clear about that from a finance department. You can leave it there. You can move it out. You have the right to do either one. If you have already retired, let's say you went out at 54, so you can't take advantage of that age 55 rule, and you've been plugging along for the next 5.5 years, now you can access TSP without a penalty. These are new ones, the next one, and that's age 60 through 63. And that is, courtesy of the Security 2.0 Act, super catch up. Okay. And I just want to make sure everybody understands that excludes me. I wasn't involved in this, or I'd be included. So if you're between the ages of 60 and 63, instead of that $8,000 catch up, you can add $11,250 for those years. You don't want to miss that. You want to be aware of that. So here's the thing. The way we view it, much like that board game, if you're prepared for it, it's a milestone. If you're not, it's a misstep. And we want to make sure that you have as few missteps as possible and maximize as many milestones as possible. Up next, age 62, my personal favorite date for FERS retirement. In my opinion, this is the earliest a FERS person should consider retirement, because if you have at least 20 years of service, you're going to get an enhanced pension formula. Instead of 1% per year, it's going to be 1.1%. Now, another interesting thing, Jen, I know you know this. If somebody reaches age 62 and they've only been working for the Fed for 5 years, what can they do?
They can get their health insurance in retirement.
Absolutely. They can retire with 5 years of service at age 62. Absolutely. Okay, age 63, this is a stealth one. This is where your income can start affecting your Medicare Part B premiums, because there's a 2-year look. So be mindful. If you retired at 62 and now you're sitting there at 63 and you say to yourself, hey, why don't I pull a whole bunch of money out of TSP to do this, that, or something else? Do the math. Work with somebody. See how that might impact your IRMAA charges in your Medicare Part B. Okay. Jen touched on this, 70.5. You can consider qualified distributions. Now, unfortunately, you can't go directly from TSP, but you go from TSP to an IRA to the charity. So that is a nice thing and can be a powerful strategy for you. Okay. And of course, up next would be the RMD ages, which used to be really simple. They were always 70.5, just like the QCD date. So now a lot of the folks that we're going to be talking to are going to be age 73 for the most part. So if you're born between 1951 and 1959, you're 73. If you're born between 49 and December 31st of 50, it's 72. And if you are born after 59, it's age 75. So now we've got a couple to keep track of for a number of years. And then pretty soon in here, we're going to be chugging past it, where those earlier ones really don't matter that much. So here's the big thing. Don't discover milestones after you've passed them. Start building around them and start planning for them. We can help, and stay tuned, because we're going to push out so much content having to do with milestones and missteps down the back half of the year. And to answer the question, who's looking out for you? Answer, it's us. And that's what I got,
absolutely.
Jen.
I love the milestones. It's going to be so helpful for so many people. So I hope people take advantage of really following that. All right. Well, I guess that's all the time we have for today.
No, we can't be done already. We're done. No.
But never fear, we'll be back next week to bring you all the latest updates you need to make informed decisions about your career and financial well-being as a Fed. Sadly, I won't be here next week, but happily, Caitlin will be back, and I can't wait to hear all about her trip and her honeymoon. I can't wait to hear. So
yeah, I always worry that one of these times they're just going to bump me out, and it's going to be the KJ show, Caitlin and Jen. But if they're going to keep me around, please subscribe to this podcast on YouTube and Spotify so you never miss an episode. And please remember to share it with your friends and colleagues, because that really helps us boost the signal. The algorithm's going to say, Feds are using this as helping Feds, so we're going to show it to more Feds.
Yeah, absolutely. And also, for more info on today's topics, you can find information on our blog at STWServe.com. Also, subscribe to our newsletter, The Weekly Serving. It's great, and you'll get all the latest news for Feds delivered straight to your inbox.
Every single week. And don't forget those live webinars that we're popping out every single week, too. A couple of good ones coming up. I know we're a ways away from open season, but start early on these things, folks. Our ever-popular FEHB Medicare and TRICARE webinar, that's going to go up on May 12th, 10:30 to 2:30. Ed is teaching. I'll be hosting. And then our TSP webinar, which gets an incredible amount of traffic and interest. That goes up on 5/20. That's from 11 till 2. And actually, we're going to be pressing Caitlin Murray into service. She'll be presenting, and I'll be the host on that. And if you are looking for a more personalized approach, reach out to us at meetings@stwserve.com. We're happy to sit down and spend time with you to make sure you understand what you have, how it's working, and how it can do the best for you.
Absolutely. All right. Well, thanks, Dan. It's been fun.
Yes. Thank you for listening to Fed15 today, folks. I'm Dan Sipe.
I'm Jen Meyer.
And I will see you next week.